Hey traders, welcome to a global macro update. In this video, we'll be going over the 1970s debt crisis and looking how other safe havens acted and reacted during that time. Mainly just looking at gold, but looking at from 1970s all the way for an entire decade to 1980, what happened, and then we'll discuss post 1980 onwards to the current day. So first off, let's just read this article here. The debt incurred over time from coronavirus stimulus spending could mean a deeper crisis and default risks for some countries, according to recent economic reports. The current wave of debt accumulation, which started in 2010 and the 2008 financial crisis, is the largest and fastest, most broad-based increase in global borrowing since the 1970s. And we can see the debt crises may be coming, the Economist Intelligence Unit wrote in late March. For now, governments are ramping up fiscal spending to fight the epidemic, maintain basic economic architecture, and keep workers in their jobs. As a result, fiscal deficits will rise sharply in the coming years. So now actually let's look at the 1970s. What happened? What caused the debt? What happened to precious metals? Mainly just talking about gold. Looking at the chart that dates back a while. I'm going to get a little bit of coffee and then we'll continue on with the video. Alright, how the great inflation of the 1970s happened. In the 1970s, the stock market is a mess. It lost 50% in a 20-month period, and for close to a decade, few people want anything to do with stocks. We'll look at that in the later part of the video. Economic growth is weak, which results in rising unemployment that eventually reaches double digits. The easy money policies of the American Central Bank, which were designed to generate full employment by the early 1970s, also caused high inflation. So then, there's going to be media pointing fingers, and we see that in the 1970s, the Great Inflation was blamed on oil prices, currency speculators, greedy businessmen, and union leaders. However, it is clear that monetary policies, which financed massive budget deficits and were supported by political leaders, were the cause. It's not the free markets. It is these monetary policy makers that meddle with free markets that don't make it free markets. They fixed supply of goods and services. They just inject basically newly printed money into the system, which in the long run obviously is unsustainable. How and why? So why did they actually even create money in the first place? Two reasons: to fund a war and for social welfare spending. Mainly it was the Vietnam War and the Great Society, which was their social welfare program that they had in the 1970s, or 1969 here. And why did they spend so much? Why did you think that it was a good thing? John Maynard Keynes was an influential British economist in the 1930s and 40s. So they, to this day, are actually Keynesian economists. This is their way of thinking. Governments should use counter-cyclical policies in hard times, running deficits in recessions and depressions. Even now, they're even going to a more aggressive approach of modern monetary theory, which is basically you can just buy your own debt and print really unlimited amounts of currency, because we've seen Japan do it for decades and there's no real major repercussions that they're having. So, we can run this thing hot for decades and decades and it seems to work, is what they're thinking. So, Nixon's deficits were also making dollar holders abroad nervous. There was a run on the dollar, which many foreigners and Americans thought was overvalued. So, a decrease in the value of the dollar, you're going to see confidence in the US dollar diminish, and then investors around the globe are going to go into safe haven assets like the gold, precious metals sector. Now introducing cryptocurrencies is a very interesting ballgame. This is something that we've seen before recently. Nixon wanted cheap money, low interest rates that would promote growth in the short term and make the economy seem stronger as voters were casting ballots. I think this is going to happen very shortly, where, this upcoming election will be basically who can provide the most free money for people, and this will cause, in my opinion, significant inflation. So we can see these are like not much of an actual increase compared to what we're seeing now. M1, which is a total checking deposit, demand deposits, and travelers checks, went from 228 billion to 249 billion between 1971 and 1972. The amount of M2 numbers measuring retail savings and small deposits rose even more by the end of 1972, from 710 billion to 802. It worked in the short term. Nixon carried 49 out of 50 states in the election. Democrats easily held Congress. Inflation was in the low single digits, but there was a price to pay in higher inflation after all the election year campaign was guzzled. It's not instant. It takes time for it to get into the system to start to see those price increases on your everyday goods and services, especially if you're giving it to everyday individuals. Unlike in 2008 when they had the bailouts, they bailed out the banks, they gave the money to huge corporations, and that didn't really affect the prices of everyday food services. It affected major assets, traditional assets like the stock market and then real estate. You saw huge inflation in those asset classes. But now you're giving freshly printed money to everyday individuals who are going to be buying goods and services, and then you will start to see the inflation in time because it's going to Main Street as well as Wall Street. So, bottom line, it would take another Fed chairman and brutal policy of tight money, including the acceptance of a recession, before inflation would return to low single digits. Major thing is accepting of a recession. Do you see any sign of accepting of a recession right now? Definitely not. They're trying to fight it tooth and nail. They're saying that it's going to be an L recovery, or there's some level of a recovery, and I just don't see it. And we'll look over the chart of the 1970s very shortly. But in the meantime, the U.S. would endure jobless numbers that exceeded 10%. Millions of Americans were angry by the late 1970s and late 1980s. So now, let's look at how gold reacted during that time. So we see during the 1970s, it was around $35-ish before 1970s. It got a little bit of a bump to maybe $45, but it was kind of bound in a range for many years, around $35 to $40. During the start of the 1970s, going in 1971, 72, 73, it did gain some traction here, and then by the time it was around 1975, it was around $185-ish. So it jumped significantly from 1970 in a few short years. Now, we did get a little bit of a lull here, dropping from $186 all the way to around $100, which is around a 45% drop. But what happened after was a monumental bull run that from 1977 all the way until 1980 rose, let's just see here, over 750%. But if you were buying around the $35 ranges before the true worry of inflation occurred, you'd be looking at over 2,000% gains here, from $35 up to, obviously you're not going to sell right at the peak, but in terms of price appreciation potential, that's just unbelievable. So we can see that if there is a worry of inflation through the 1970s, safe haven assets like gold do provide a not only stability in your wealth, but huge exponential increases here. And with crypto involved within the current potential monetary policy that we're going to be implementing with the full reset, we have no idea how much blockchain will be implemented with really the kind of the new world order that we're going to be living with. Because during the 1970s, we got off the gold standard, where we got off the Bretton Woods system, and fiat currency was introduced. We didn't have any backing with gold before that was cut. We did have to have some level of backing, but in 1971, I believe, or two, when the Bretton Woods was cut and fiat currency was introduced, you didn't have to have any backing. It was just a confidence game for fiat currencies, and that's why you saw huge inflation. And right now, it's just confidence game right now, too. Look at how much money printing is occurring within the United States. It's unbelievable. Just going to finish it off with the stock market here during the 1970s to the 1980s. This right here is January 1970, and then we see the 1980s right here. We just see some chop all around. We're seeing lower highs. We saw a massive sell-off. That was that 50% sell-off that we read about, 45, kind of from main candle closure to candle closure. And then we saw a massive rally with a huge double bottom And we did talk about the 1930s, and we saw that huge decline in the stock market, but we could get stagflation, where we're just seeing a consolidation sideways. We don't exactly know until we start to see this all play out. But it's really, really helpful, in my opinion, to look at previous historic times where we've seen huge money printing, or we've seen a massive bubble, like the 1929 huge sell-off, and then we saw a massive bounce. Looking at previous historic price action, looking at situations where we've seen massive inflation or potential for massive inflation occur before is a great way, in my opinion, to try to understand what could possibly come into fruition in the future. So thank you very much for watching. That is the completion of the global macro update. We really hope you liked it. If you found this useful and entertaining, please subscribe to our channel. It would help out greatly. And if you would like a community, a Discord, that shares this kind of information absolutely for free. We talk about it all the time. Definitely check the link below within the comments. We do have a link down there for our Discord. So thank you very much for watching, and until next time, have a good one.